Hello, everyone. Welcome to today's deep dive into China's expanding economic landscape and market rally.
Good afternoon. My name is Stefan Kreuch. I'm the CEO and co-portfolio manager of the HSZ China Fund.
And this is Wen Jie. I'm the partner and portfolio manager of the HSI China Fund. So over the next few minutes, we'll explore how China's technology investment, government policies, and equity market dynamics are shaping the future of its economy and what this means for global investors. So there are three topics we would like to cover today, which are China's AI initiative and what we hear on the ground, and lastly, market outlook.
Let's kick things off by talking about AI. It's everywhere these days, isn't it? Back in March 2025, during our marketing trip to Switzerland, we told investors that the DeepSeek moment in China is really changing the way how people around the world see China. At the same time, that DeepSeek moment also sparked a new wave of entrepreneurial energy and spirit in China. Fast forward 6 months, and we are now seeing investments picking up speed. Just look at Alibaba as a standout example. Ever since Jack Ma returned to the campus early this year, the company has been ramping up its investments. Some folks are even calling it the MAGA, Make Alibaba Great Again moment.
And we observe it's not just pouring money into AI. They're also shaking things up for competitors like Meituan in the food delivery business. Recently, Alibaba just announced another 1 billion renminbi into AMAP, offering subsidies and aiming to really change Meituan's grip on the market. Now, some might argue this is unproductive investment, but we have a different view. The fact that these companies are investing reflects their confidence level on growth. Chinese companies have a history of gaining competitive advantage through these hyper competitions. 10 years ago, if you remember, people were questioning about the unproductive investment going into the electric vehicle sector. But today, the survival like BYD is becoming the global leaders. Like we highlighted in our previous Swiss marketing trip, investment will create jobs. And through natural selections, some will drop out and new industry or business models will be created.
Let's dig a bit deeper here. Alibaba's ambitions are going way beyond what we've already talked about. Their AI chip division, called T-Head, just landed a big win by signing up China Unicom as a customer for a massive new data center in Shanghai. We are talking about a deal worth around 390 million or roughly 2 billion renminbi, which is actually double the size of the 1 billion renminbi contract Baidu's AI chips got from China Mobile. These kinds of deals really show how serious China is about building its own tech capabilities. They're aiming for 70% of their tech to be homegrown by 2027. So the AI race in China is definitely heating up.
Secondly, we would like to provide you an update of what we hear on the ground.
Look, we know August numbers looked pretty soft. Consumer confidence was low, people weren't really taking out new loans, but honestly, don't get too worried about that yet. If you look back at history, this is when the government usually steps in, and we're already seeing signs of that. Just recently, on September 17, the State Council held a press conference and rolled out a bunch of new policies to boost service consumption. That's a clear sign they're acting. The property sector is still struggling, we know that, but it's tightly managed. So the government is gearing up for a huge 1 trillion renminbi bailout to help local governments pay off their outstanding bills to the private sector. They're really trying to support the system and keep things moving.
Now, some bear argues China is following the path of Japan, and we have highlighted repeatedly that China could avoid it. People learn from their past mistakes. The institutionalization of the equity market, meaning having domestic pension or insurance companies increasing their domestic equity allocation, or regulatory initiative trying to push corporate buying back their shares to improve ROE are the good example. China is mimicking the policy under the Japanese Abe administration It is trying to prevent the kind of deflation and economic stagnation which led to Japan's last decade. Government policy is oriented towards preventing that outcome through targeted stimulus, easing property buying restriction in the top tier city, and supporting infrastructure investments.
To wrap things up, let's talk about where the market is heading. Chinese stocks have had a great summer and the early autumn that was very strong. There's been a big rally, mainly thanks to a combination of strong liquidity and upbeat policy signals. We've seen both the bigger players and the smaller companies take off, and H shares have even hit their highest level in years. In our view, this rally still has legs. Valuations are still pretty reasonable, retail investors aren't going overboard, and there's a lot of room for more money to flow into stocks, both from within China but also from overseas.
We will highlight some key drivers of rally, which are liquidity, valuation, policy support, retail sentiment, and asset allocation. So on the liquidity, global liquidity conditions have fueled equity returns, including China's, even as macro data shows signs of cyclical softness and earnings revision for the broader market, not for the holdings of HSI China Fund though, remain muted. On valuation, MSCI China is trading at mid-cycle level and has a significant discount versus developed market. On the policy support, which we have discussed earlier, the recent policy pivots, easing of trade tensions, regulatory reforms, and campaigns to support the private sector have helped the valuation and compressed equity risk premium. On retail sentiment, while retail activity and speculation have increased, sentiment measures show risk appetite is not yet near historical peaks, suggesting further upside potential before the euphoria-driven reversal might set in. Lastly, on asset allocation, Chinese household remains underinvested in equities compared to property, and there's a scope for substantial asset reallocation to equities, supported by excessive savings and uninterested property market dynamics.
Looking ahead, we are still feeling good about things. The average margin of safety for the stocks in our HSZ China Fund is around 50%. So if you go by what happened in the past, there's still room for another 20 to 30% upside, assuming the strong liquidity and supportive policies continue. And this rally isn't something we're only seeing in China, by the way. Actually, most big stock markets around the world are close to or hitting all-time highs, mainly thanks to all the liquidity out there. The difference is that China's stocks are still pretty cheap in comparison. Currently, the MSCI China is only trading around 60% of its previous peak.
Of course, there are risks we keep an eye on. If liquidity suddenly dries up, if there's a regulatory surprise, or if policy disappoint, we could see a quick reversal. History shows that. But right now, the fundamentals still look solid. We're expecting earnings for the index to grow at a high single-digit pace. And judging by the way money is moving and how investors are positioned, there's still potential for more gains. Now, that's it. Thanks for joining and listening to our deep dive. And please stay tuned for further insight as we continue monitoring these dynamic trends. And see you next time. Thank you.